Today, we'll be hearing from Ava Archibald about estate planning and why it's so important. Ava specializes in helping clients plan for the future success and prosperity of their businesses and families. Since 2006, she has provided Eide Bailly clients with her expertise in transition and estate planning, as well as gift and fiduciary compliance and overall financial planning. When you work with Ava, you get a big picture advisor. She understands that you've worked a lifetime building your assets and will do all she can to help you protect your wealth. Ava looks at your entire plan from both a tax and financial perspective, listening to your goals, reviewing your planning documents, and illuminating the finer points so all parties have a clear picture of what the numbers will look like as that plan is carried out. And with that being said, I'm going to go ahead and turn our time over to Ava.
Thanks, Amanda. Good morning, everyone. As Amanda noted, I am Ava Archibald. I am the partner in charge of our wealth transition services of Eide Bailly. If you're not familiar with wealth transition services, that is just what it sounds like. I work with clients when they are looking to transition their wealth or their business operations down to the next level, whether that be during lifetime or at death. And at Eide Bailly, we take that approach as a holistic approach. We're looking to preserve the wealth and minimize your taxes using both lifetime and death planning tools. We want to ensure that the attainment of your personal goals and your family dynamics match with your business exit objectives, whether that's one lives or one dies. We're coordinating that business succession plan along with your estate plan. So where does that bring us today in our current estate tax environment? Well, under the current law, we have an estate tax exemption of $11.58 million, increased to $11.7 million in 2021, with an estate and gift tax rate of 40%. That exemption is available for gift, estate, and generation skipping tax. We have portability, which if you're not familiar with that term, I'll address in just a few minutes. And we have an exemption that is set to sunset in 2026 to an amount that is $5 million indexed for inflation, which we think will be somewhere around $6 million at the time we hit 2026. We also have annual exclusion amount available that you can gift to anyone, $15,000 per year, whether that be in 20 or 21, that amount stays the same. But this amount is over and above your estate tax exemption. So that $15,000 is an annual exclusion amount available every year. You may have heard the term clawback, or many of our clients have had questions about clawback. When we have this higher exemption of this $11.5 million, and we think it's going to drop to $6 million in 2026, the concern we've had for clients is, will they be taxed on that difference? Will the IRS try claw back that? I think of as a bonus, the difference between where we'll be in 2026 at $6 million to the $11.5 million. Will they try tax that bonus amount if one would die in 2026? And the answer is no. We have final regs in November of 19 that state that the estate tax exemption at death is computed using the higher of the exemption you've used for applicable gifts during life, or your exemption at death. So if I die in 2026 and the exemption is $6 million, but I've used $11.5 million prior to that, they're not going to tax me on that difference. The other concern I hear from clients is, if I wanted to use that bonus amount, the amount of the $5 million between the 6 and the 11.5, can I gift from the top down? And the answer is no, you gift from the bottom up. So if you want to use the bonus amount, I have to give all of the 6 and then I get into the bonus and I use that additional amount. So if I was a taxpayer and was going to use $11 million of exclusion and split that with my wife or husband, each giving $11.5 million, in 2026, each spouse would only have $500,000 left of exclusion because they've used the first 5.5, and then in 2026, If it's at 6 million, you'd have 500,000 left. Where if a married couple gave all of that exclusion, that 11 million from one person, so let's say my husband gave 11 million of his exclusion now, in 2026, I would still have 6 million. So as a married couple, we would have more. So remember, if you're using your exclusion, you're using it from the bottom up. If you're going to use a higher amount of exclusion and try use that bonus, you might want to do that from just one spouse instead of both, if you're limiting it to certain amounts, such as like 11,000. So where are we in the current environment? In our planning world is much different than what we've had in the past. With this Corona pandemic, we're seeing suppressed values of, a number of marketable securities for some for their family-owned businesses. The values are less than what they had expected or previously had known. We have historic low interest rates, lower than I ever remember in my 30-year career. The IRS sets an AFR rate, and their gifting rate is referred to as a 75/20 rate. That gifting rate is at 0.4%. I don't ever remember seeing it that low. We have a government deficit, a massive federal bailout, and there might be another one in the future that we have to think about. How is our government going to pay for that deficit that has been created and will maybe be even larger? We have clients who are now worried about asset protection and access to funds if they're going to use the higher exemption. From the asset protection side, maybe now they are concerned about creditors where they may not have been before. So they might want their assets in an asset protection trust. We have some children who are specifically asking their parents, if you're going to give me any assets, put it in a trust for me so that it can be protected from creditors, because I just don't know what the future will bring. For clients who want to use their higher exemption amount, we have some that are saying, well, I'll use the exemption amount, but it's so high right now, I don't know if I want to give up the cash flow. Is there a way I can use the exemption and still get the cash flow from those gifted assets? And the answer is yes, if you do the right planning, which I'll discuss in a few minutes. And we also have this future adjustment to our estate tax exemption, where we really don't know where that might be. For Biden and Sanders, had a unity task force recommendations that they set out in July of 2020. They noted that the estate taxes would be raised to a historical norm, but didn't define what a historical norm is. So what is that? Some of us have thought of that as maybe they're going to look at having these sunset provisions come and happen sooner than later. We also have the political campaigns where the Democrats have discussed having the gift and estate tax exemption possibly drop to something like 3.5 million, or raise the estate and gift tax rates from 40% to 50 or 55%. That 40% kicks in if I've used my exemption during life, or at death if I have assets over my exclusion. They've also talked about doing away with the stepped up tax basis. And what that stepped up tax basis is right now, if I die owning assets, but if I'm not over the threshold, a stepped up tax basis is a great benefit, because my new basis to my heirs is going to be the value on the date of death. So example is, my dad is not over the exemption of 11.5 million, owes farmland that he received during the Depression. My siblings and I are, telling Dad, you hold that land. Let's get a stepped up tax basis when you die. So if we have to sell that land after your death, there won't be any capital gains to pay. Biden has suggested about doing away with that stepped up tax basis. So if we did away with the stepped up tax basis, that could generate some significant capital gains to some of our clients, as well as if he lowers the exemption estate tax. There are commentators and nationally known speakers who are professionals in this area that really have a concern that that exemption might drop to something lower fairly soon if the Democrats do have control. And there's also consideration from some that even if that change happens, maybe later in 2021, that they may make it retroactive to January 1 of 2021. Others are not so concerned, thinking that there's so many other issues that have to be addressed right now. Estate taxes might be on the back burner. However, if they look to generate some tax, estate tax is an easy sell to the average American, that just to update to increase estate tax or lower the exemption is easy to have people buy into for the average American. When we look at where we are right now, we have Biden, who is our president-elect, but we don't have Trump really accepting that yet. We have the Senate, who that isn't going to be, that Congress isn't going to be decided in the Senate side until probably January. And if we have the votes, Democrats, winning the votes in Georgia, which I think is January when that's going to be settled, we'll have a 50-50 split, and it's going to be the vice president who is going to break that tie. How much will really pass for some of the new legislation? I don't know. It'll be interesting to see. What we do know today is we do know what our exemption is. We do know we have the sunset provision. We do know there's a discussion of a possibility of reducing that exemption. Sorry, I just had a problem moving my slides. Here we go. So what that brings us to now is time. The time to plan is now. You might want to review your documents to be sure that they provide for portability and the flexibility of the change in the exemption. If it's your intent to use the higher exemption, maybe you want to set yourself up so that you can easily pull the trigger if it looks like something will change. I have some clients who are getting their trust in place. They're not going to fund them now. They're not going to make the gift, but they're going to be ready to transfer assets if that exemption looks like it's going to drop. I have other clients who have real estate holdings that are splitting out maybe the assets in their partnership to low basis assets in one partnership and high basis assets in the other partnership, ready to gift to the high basis partnership assets if that exemption is going to drop. Or clients who have a partnership that have some highly appreciated assets or assets that will be appreciating. Maybe the client I'm thinking about has land just right outside city limits that could almost double in value. They're going to break out that real estate and look at gifting that land that might appreciate if this exemption is going to drop. To me, it's deja vu of 2012. Where the exemption was at 5 million and dropped to $1 million. We had a lot of people coming forward at the end of the year and wanted to do planning. In my 30-year career, this was the busiest year I've ever had in 2012 because everybody wanted to do this planning for their 5 million that they thought was going to go away. It happened that it didn't go away. And we actually had some people who used the 5 million and then came back to us after the year in 2013 and want to know if they could get that $5 million back. It doesn't work that way. If you're going to use those higher exemption amounts, you have to be comfortable in doing that, or you don't take it back. The only way you get those assets back is the person who you gifted it to would have to gift it back to you. So time is now to have the discussions and work with your advisors. Professional advisors only have so much time if you're looking to do something before year end. So get your name on their list, let them know you're thinking about it. And even if you're taking some steps to arrange your assets or set your trusts up for maybe next year, start now so that you are ready. With portability, that is something that came about in 2012. Where if I didn't use my exemption on my death, my personal representative could file an estate tax return and make an election to take my exemption and make it portable to the surviving spouse. So if I died today and my exemption's 11.5 million and I didn't use it and I passed everything to my spouse with a free marital deduction, my husband Jim could file an estate tax return and make the election to have my 11.5 million transfer to him. In 2026, he would have his 6 million plus my 11.5 million. My 11.5 million won't be lost or adjusted for sunset. It also won't adjust for inflation. It sits stable at the 11.58 million that it would be today. That credit is available to him even in 2026 if it drops to 6 million. His would be 6, but he would have mine. If he makes gifts in that time period, he's going to use from my exemption first. And my exemption is only available to him as long as he doesn't remarry. Planning with portability has been a great opportunity for our clients. However, it sometimes makes planning more complex. The benefit of estate tax inclusion is something you think about on the second death. We have simplicity if we leave everything to our spouse and make that portability election, but sometimes we don't know if we want to do that until that first spouse dies, because it's going to depend. In our case, it would depend on what is the age of my husband, what's Jim's age, what's his health, what are our assets, and how much will they be appreciating. That's going to make the determination on whether or not he wants to have that portability election. If I died today and we're both in our mid-50s, he may live until he's in his 80s. And if he lives till he's 80, my kids would get a second stepped up tax basis if everything passed to him and he held it till 80. Maybe that's even a better opportunity for him than using this exemption today. It becomes a post-mortem planning tool, an after-death planning tool. I think you have to look at death. What is the age of the spouse, the health, the assets you have to determine whether or not you want to use portability. You also want to look at state estate taxes. I'm a Minnesota resident, so our exemption is $3 million per person. No states have portability available to them at the state level. So maybe in our case, we have thought about maybe it's the first 3 million we pass to our children or use the exemption of my death, and everything else would pass to a surviving spouse. There are risks that happen with that portability election. For if my husband Jim made this portability election right now, but he remarried, he would have the cost of filing the estate tax return with no benefit because it's the exemption of your last deceased spouse. That my exemption does not increase with inflation if I die today. So if my assets are highly appreciable, maybe it's more beneficial that I use the exemption today than letting them increase or maybe double in value, increase much more than the inflation. Generation skipping tax, that's a tax if I don't give to my children and I skip down to my grandchildren, there's an additional tax that can be generated. Portability does not work for that tax. And as I said, no states have adopted portability. So if you're in your state, if you are in a state that has estate tax, you might want to think about that. And another thing to consider is the statute of limitations on the estate tax return if I die today doesn't start until my husband dies. So if that is in his 80s, 30 years down the road, they could still come back and look at my estate tax return because they're going to look at my exemption. So for a mid-size estate, many estate plans now may be out of date because maybe they didn't allow or address portability, or surely may have not addressed the unknown flexibility we have in the exemption that we have today. So estate tax planning and income tax planning must be considered together, because if you're looking for that stepped up tax basis, sometimes that's more important in a smaller estate. Or a mid-sized estate, which we think of right about the exemption levels, you want to make sure you have flexibility. Prior to 2012, we saw a lot of plans that were drafted with credit trust and marital trust, sometimes referred to as a family or marital trust, where on the first death, the full exemption amount went into this credit trust or family trust, and everything else went to the spouse or a marital trust. Well, what transferred in that credit trust or family trust used the estate tax exemption up to the full exemption. Those beneficiaries, then their tax basis was today's value. They never had the chance to have a second step up. Now you may want to consider maybe passing everything to your surviving spouse. And if your spouse decides they don't need those assets, or it's beneficial to use my exemption if I die today, they could disclaim those assets into a trust. So you may see a disclaimer trust in some of the currently drafted documents. Or in my case, if I died today, I would really hope my husband Jim would remarry, but I want our land and our assets to pass to our children of today. So if he remarries, I want everything in a trust that he can have the income for life, but the remainder goes to our children today. It's set in place. That type of trust can allow you to make what's known as a Q-tip election. I can put it all in this marital type trust for Jim with those rules set in place, but he can decide on my death how much of that trust he wants taxed on my death and how much he wants transferred to him, how much exemption should be portable to him. That's by making a Q-tip election. So many times we see now planning documents drafted in that matter. So you have that flexibility. You have the options left on the table on whether or not you want to make a portability election and how much you want to make that portability election at death. I just reviewed a plan here in this last week that was updated in September. But when that plan was updated in September, it still allowed for this credit shelter trust that on death, the estate tax exemption all goes into a trust for the benefit of the children. That leaves no options for that surviving spouse to make a portability election at death because the whole exemption is going to the trust for the child on the first death of the first spouse. Is that the best option? Maybe it should be something of setting it up in a trust and let the spouse make the decision if they want to use portability or not. But in this case, this plan fulfills a credit shelter trust. The spouse gets the income stream, the remainder goes to the children. There's no ability for them to make this Q-tip election because of the way that trust was drafted. It'll be a conversation I'm going to have with the client to see if that's exactly what they want. When you're planning for the mid-size estates, again, the things you want to think about is the current federal and state tax laws, the estate value at death, and the future growth of the assets. That desired stepped-up tax basis will often take precedence over the estate tax exclusions. You have to run the numbers. So when you're working with us at Eide Bailly, we're looking at your plan from the tax perspective. We're going to try to illustrate that with a very simple flow chart, showing what are your total assets, what's the tax on the first death, how does it pass on the first death, what's the tax on the second death, and see these buckets at the end of the second death. Maybe one child, could be 5 children, could be children and grandchildren. But I think when people see the illustration and put the numbers to the plan, you can really see if this plays out the way you intended. Many times I'll bring up an example of a client who brought me a red book. Oh, beautifully drafted documents. I mean, every document in there was drafted very well. The book was a fancy, nice, shiny red book. But when I illustrated it and showed them what the tax was on the first death, second death, how did the buckets play out, wasn't quite what they expected. So sometimes you have to put the numbers to the planning documents to see how it looks from a tax perspective. Many times we're going to partner up with an attorney when we're working with our clients so that we make sure it's a well-drafted legal document or well-drafted planning documents and also makes sense from the tax side. So with that, I'm going to transition over to charitable planning for farmers. There's a lot of benefits. If you have charitable intent with planning with some of your farm assets. There was an act that came out after the coronavirus, the CARES Act, and they addressed some charitable deductions, one being that you do have the ability to make a $300 charitable deduction in 2020, even if you don't itemize. Otherwise, if you make a charitable deduction, usually that's noted on your Schedule A and itemized, but the standard deduction right now for a married couple is fairly high, like $24,008 in 2021 and $12,004. So does it make sense that you want to, will you even be able to use a charitable deduction, because maybe you won't meet the threshold of the standard deduction, causing you to itemize. Here you at least get the $300 deduction. There's also a change where the limitation of cash gifts used to be 60% of your AGI. That's what you could take on your itemized Schedule A. In 2020, they're allowing you to have 100% of your AGI for cash charitable contributions. That can make a significant difference. However, both of those opportunities are only available, but not to a donor advised funds or private foundations. So they're available to charities, but not to donor advised funds or private foundations. I had a client who was selling his business and was really excited about this, but he was leaving his cash request to a donor advised funds, and we had to have him rethink that if he wanted the charitable deduction. If you're looking at farm commodities or raised livestock, if you donate that to charity and have the charity sell those assets, that could result in both an income tax savings and a self-employment tax savings, because the charity doesn't pay tax. If you have unsold inventory, that can, if you gift that unsold inventory before sold, you can remove that income right off your tax return. So you don't even have to itemize to get the benefit. You just don't have the income reported on your tax return. It avoids the need to itemize that charitable deduction. The caveat with this, though, is the sale must be reported by the charity and not by the operating farmer. So issues you want to consider: the commodity. If you're looking to have a commodity sold by a charity, that commodity should be delivered to the elevator, but the storage receipt issued to the charity. The receipt should then be delivered to the charity. Don't have it back to the address of the taxpayer. Confirm with a letter from the donor indicating that the commodity belongs to the charity and may be sold by the charity as it desires. It's not the farmer giving the instructions of when you're selling that commodity. The charity has to give those instructions. And if you have farm machinery, especially if you're looking at a significant amount of farm machinery, you might want to consider a charitable remainder trust for your depreciated property, because as you sell that farm machinery, you're going to generate some recapture tax. But if you gifted that farm machinery to a charitable remainder trust, which is a trust that we create, that a donor gives assets to a trust, but gets to receive an annuity payment over a term of years or at life. And then at the end of that term, the value of that trust goes to charity. Well, if a taxpayer gifts their machinery to a charitable remainder trust and the charitable remainder trust sells the machinery, then you can stretch out that capital gain over a number of years, because as you receive that annuity payment, whether it be a number of years or your life, you're going to stretch out that capital gain coming back to you over a time period. So instead of having all of that taxed to you in the year of sale, give it to a charity, a charitable remainder trust. Let the trustee sell that machinery, and then you can stretch out that income to you over a number of years. Another thing we see many times with operating farmers is the use of life insurance. I think of life insurance as a great filler in estate planning. So you might need to use life insurance, maybe for liquidity, for the payment of estate taxes or debts. Maybe it's the purchase of the farm property by the farming children. So maybe even a farming child in the operation might have life insurance on mom or dad, and when they die, they will have the ability to have cash in hand to buy out their siblings. Or maybe you use the life insurance within my estate, if I'm the operating farmer, to distribute to my non-farm children. However, if I own the life insurance policy and control who benefits from it, it's includable in my estate for estate tax purposes. But if I have it owned in an irrevocable life insurance trust, many times referred to as an ILIT, that life insurance policy is out of my estate. So if I create a trust and I have the trustee purchase the life insurance policy, it's not taxed on my estate tax return. I could gift cash to the trust so that the trustee has the ability to purchase the payment, and I could use my annual exclusions to cover those premium payments. It works well to give the beneficiaries of that trust, who usually receive it upon my death when the policy is paid, the ability to have cash to maybe buy out other family members or maybe to pay the estate tax. But with the higher exemption, we have a lot of clients who now are wondering, do they still need their irrevocable life insurance trust? Well, I ask my clients to proceed cautiously if they are going to do away with that, because we know the law today is 11.5 million, but it's going to drop in 2026 to about 6 million. We don't know what will happen here with the future if the Democrats do come into control. Will it be something less? So instead of maybe cashing out that policy, think about what you need in 2026, or do you have the ability to pay the estate tax if the exemption drops more? If you want to reduce the benefit of that life insurance policy, maybe talk to your agent. Is there a way that I could reduce the death benefit and have a paid up policy? Consider the terms of the trust. If I surrender my cash surrender value and it goes into the trust, does it get distributed or does it get trapped in the trust, still sitting there until my death? You might have to look at the terms and you may have to reform the trust. Many states allow statutes now that you can change a trust for particular reasons, or you may have a trust protector, someone named in your trust that could change the terms of the trust. Just proceed cautiously if you are going to do away with your irrevocable life insurance policies. Another planning tool we use often with farming families is farmland partnerships, but there's concerns you need to think about with estate and gift tax if you are creating these farmland partnerships. They work very well to maintain the successor's operation. Many times these operating farms, really to be a viable farm, you need all of the farmland to continue to be available to farm for the farming children. Well, you could put that farmland in the partnership and have restrictions in that partnership that if a family member is farming, they have the right to, a first right to farm it. But what does that do for your non-farm family members? Sometimes it's difficult for farming children to buy out the non-farm children with current values. This way, if you have it in a partnership and the farming children can operate it, then the non-farming children can benefit from that land, maybe being rented to the farm operation. You also, for gift and estate tax purposes, if you create a limited liability partnership with limited interest and general partnership interests, those limited interests can receive a significant discount, sometimes up to 30%, 35%, for lack of marketability and lack of control. It also makes it easier to make annual gifts, because if I was going to make annual gifts of my farmland, I would maybe transfer 20 acres of land every year just to keep under the annual exclusion, but your recorder's office is not going to appreciate all those deeds. It's going to be hard to track, and some counties don't even allow minimal acreage to be on deeds anymore. So if I put it in a partnership, I could make annual exclusion gifts with a simple assignment of maybe 2% of the partnership each year, or whatever it would require to use your annual exclusion. As the farming parents, let's say, if you create that partnership, You can set the buy-sell terms now while you're alive for the family. Not that they couldn't always revise them later, but it really sets the tone to the family of what is the parent's intention for that farmland. You could have discounts with tenants in common property, but if I gave my land and tenants in common to my 2 children, each an undivided 1/2 interest, what if my non-family child wants to get out of the ownership of the farmland, wants to sell it? Now what, are we severing that farmland? And how does that play out for the operating farmer? By having it in a partnership, you have a better chance of keeping a viable farm operation with all of the land being operated together. But for gift and estate tax purposes, there are issues you want to consider. If you're contributing land, you want to make sure that the interest is proportionate and the value contributed is credited to the capital accounts accordingly. You must have a bona fide business purpose, which is easy to do in a farm operation. There's a reason to have all that land in a partnership. If you start gifting interests of that partnership, the annual distributions of income should be pro-rata to the ownership. So if I gifted 10% of the partnership to my children, I need to gift 10% of the income each year if I'm making distributions. I can't just make all the income distributions come back to me, but give my child a 10% owner of the partnership. The IRS would pull that back on your estate tax return, saying that you did not give up control. You also want to avoid personal assets being in that partnership, like your personal lake home, or paying your personal expenses like your grocery out of the farm partnership account. I have seen that. That can taint it for gift and estate tax purposes if you're looking to obtain discounts on death of the ownership of that partnership. Also, you don't want to have the partnership to be the only asset that can pay your debts at death or your estate tax. Make sure you keep some assets outside of the partnership. Otherwise, the IRS really looks at it that you kept control and would try tax it on your estate tax return at death. If you're looking to gift ownership in that partnership during lifetime, or take the benefit of discounts for lack of control or lack of marketability on your estate tax return, be sure you do not treat it with personal assets or like it is your personal asset. If you are creating a partnership with general partnership interests and limited partnership interests, be cautious that the parent doesn't keep too much control by keeping all the general partnership interests to one person. So if husband transfers all his farmland into a partnership, maybe with his wife, and then they give assets, limited interest to the children, but dad keeps the general partnership interests all himself because he wants to control the show, the IRS would look at it that you didn't give up control and may pull back those gifts. Own that general partnership interest with maybe your spouse or maybe one of your children. That way you didn't keep all the control yourself, and the IRS won't question that it's a completed gift. So with our unknown future, what are some of the planning ideas we look at? Well, we look at interfamily loans. That's a very easy way to gift quickly if we think the exemption is going away. Spousal access trusts. If I want to use my higher exemption of that 11.5 million, but I don't want to give up the income stream, I could use a trust for the benefit of my spouse. Gifting my 11.5 million in a trust for my husband, he gets the income stream for life. Balance may go to children at death. That, as long as we're married, I didn't give up the income stream. I'll address that in a little bit in more detail. We also have sales to defective trusts. Defective trust means a trust that's out of my estate for estate tax purposes, but I may be still taxed on the trust assets for income tax purposes. There's planning we could do with that in these unknown times as well. And the last thing that we see in planning is defined value clauses. When it came to 2012 and everybody was trying to rush to use their exemption, they were running out of time to get real estate appraisals or a business valuation of a partnership. So what they did is they made sure their transfer documents noted that they were gifting X amount of value, not a particular asset. That way we could value it after the fact if we could not obtain those appraisals or business valuations before year end. Another thing I'm seeing this year with these low interest rates is if you have interfamily loans, a lot of people are considering refinancing those loans. So if you have loans with your entities or loans amongst family members with these low interest rates, maybe you want to reconsider restructuring those loans. If you do a refinance, there may be a benefit to having maybe just a slightly higher interest rate than the AFR, or a higher interest rate on a default, or maybe make sure there's a partial principal payment when you refinance so that it looks like a true business transaction and not a gift. But ensure prepayment is allowed if you refinance these loans. And look at the structure. Is this an ideal time to maybe change the term of that loan? We could pay the interest to date, or we could refinance the interest and roll it into the new loan. We have some flexibility, but I've had a lot of clients refinancing interfamily loans with these low interest rates. Here's an illustration of the spousal access trust that I mentioned. A grantor could transfer, let's say partnership units, into a grantor trust and make the spouse the income beneficiary, and on the spouse's death, it would pass to children or maybe remain in trust for the children. But if I wanted to use my $11.5 million today, but I didn't really want to give up the income stream, I could transfer $11.5 million of a partnership interest into the trust, or maybe it's just $11.5 million of bare farmland into the trust, with my spouse being the income beneficiary. And as long as we're married, I didn't really give up the cash flow because it would go to my husband, but he'll share that income with me. At least I think he's going to share that income with me. And then at the end of his life, it would go to my children. As long as he never had an ownership in that property, he wasn't the transfer of the property to the trust. It's not going to be included in his estate. So spousal access trust allows us to fund an exemption to a trust using the transferring spouse's exemption. So if I'm creating the trust, it's using my exemption. The trust agreement provides for discretionary distributions of income to the spouse or maybe even descendants. I could have it just to my husband, Jim, or I could have it to Jim and discretion to my children. If I have an independent trustee, it gives me a benefit of having a broader range of discretionary distributions. The trust is not includable in the gross estate of my husband. He won't have a stepped up tax basis. My children or the beneficiaries, remainder beneficiaries, would take my tax basis because I'm making that gift during lifetime. And I could do this myself and my husband could do it. So we could both gift $11.5 million and have two spousal access trusts. He sets a trust for me, giving me the income stream, and I set up a trust for him, giving him the income stream. We've used our higher exemptions, but we haven't given up the income stream. But if we do both create a trust, we don't want it to be reciprocal. We don't want it to be identical, but the IRS will not allow that. That will not look like a true separate gift. So maybe we want different powers of appointment in the document, meaning I could appoint maybe heirs of who I want to receive them, and they're not specifically named. Maybe we want to create the trust in 2 different states, or maybe even 2 different tax years. We could defer the distribution and the termination terms. Maybe on my trust pays out to children on death and Jim stays in trust. One trust may have a trust protector, someone named in the trust, an independent person who could make changes to the trust, and the other one may not. One may be passing to my grandchildren, so a generation skip, a GST trust, and one may be the children. There are many different options you can use to make them different. I've listed a couple here of just if I was setting up 2 trusts, how I would make them different. If you're going to do that, maybe read through that. These are some options you can use to create the trust to make them different. I want to share with you an example of a client that I recently visited with in using these spousal access trusts and how it benefited them. So I had a married retired couple, 3 children, 2 children actively farming. There was a potential for divorce issues, and they had their own taxable estates. 13 million of farmland was the discounted value if we put it in a partnership, 10 million of closely held stock in a separate operating entity, and $7 million of other assets. So total value of 30 million. In 2020, they would have a $2.7 million estate tax liability, and in 2026, a $7 million estate tax liability. So their goals were to use the 11.58 million in 2020. They wanted to retain the income back to themselves, however, and they wanted to keep the farmland in the family after death, and they also wanted to provide divorce and creditor protection. So some of the issues we had to look at is that closely held stock owned by the husband was all owned by the husband. Do we need some available for the spouse to gift? And are there any issues in the control documents of that closely held partnership to gift anything? We have 2 children who are actively farming, and one isn't farming and completely out of the area. And how do we provide for that child? So what we worked on with them is putting the farmland in a partnership, which allowed us to have that discounted value. It also provided that a means to keep all the farmland together for those 2 operating farm family members. 1 child and the husband owned an equal share of the general partnership units. So when I work with clients to create these, I always try to have a small general partnership interest, like a 1%, and 99% limited partnership units, so that I can use those for gifting, or it gives us a better discount on an estate tax return. I had them gift 1/2 of the general partnership units to a child, so that dad and farming child shared that general partnership unit, so dad didn't have full control. We created an spousal access trust for each spouse, and we gifted 1/2 of the limited partnership units to the access trust. So mom gifted limited partnership units to the spousal access trust for the benefit of her husband. Dad gifted had a spousal access trust with LP units. We split the ownership of the non-voting closely held stock that dad owned with his wife, so we could use some of that to gift in each trust as well. And it helped us balance things out. And we made sure we reviewed the buy-sell agreements to ensure it met the family goals, so that these 2 sons under that partnership agreement could continue to farm, but still provided income stream, so that the non-farming child had some benefit. So in 2020, the gift tax exemption was used. We provide creditor and divorce protection for the family farm, both at the partnership level. We can add some of those restrictions within the partnership agreement, and that it was in a trust, provided creditor and divorce protection. The spousal access trust allowed for the spouses to maintain a cash flow as long as they were married, and it's upon the spouse's death, the income would pass to the children, either outright or in trust. The estate tax savings of using this plan saved them $4.5 million by making sure they used their higher exemption today. They didn't use the cash flow, but come 2026, they're going to save $4.5 million in estate tax. Well worth the step of having those extra trusts. Here's a sale to a intentionally defective grantor trust, which I mentioned is used at this time when we don't know where the exemption will go as well. In this case, you create a grantor trust. This is not an income tax saving technique, because an intentionally defective trust gets the assets out of your estate for estate tax purposes, but income tax purposes, the grantor is still taxed just as if he owned those trust assets in his name. But what we do here is we take advantage of the discounts available for business entity holdings, such as a partnership. Again, if I have a limited partnership unit, I can discount that to 30 to 35%. So let's say I have farmland valued at $10 million. I put that into a partnership. If that limited partnership interest is valued at 10 million, but I can discount it to 7 for gift and estate tax purposes because it is a limited partnership unit or units, I sell it to the trust and I take back a promissory note. Because I am the responsible taxpayer for the grantor trust, there's no capital gain paid on this transaction. So I've just shifted $10 million of value of assets out. I've taken a note back for the discounted value of $7 million. That $3 million of discounted value is out of my estate tax free, sitting in the trust. Once the note is paid off, the assets could go to the trust beneficiaries, may go outright to children, but I need to keep the trust in place and I need to pay the income tax on the trust while it's in place. But the benefit for this in uncertain times, it allows the taxpayer to position them in a good place to pull that trigger if they want to use the exemption. So right now I take this note back, but if the exemption is going to go away, I didn't use the exemption when I sold it to the trust, or very little exemption at that time, but I take this note back of $7 million. If I give the note away, I've used $7 million of exclusion. Very quickly, I could give up that note if it looks like the exemption is going to go away. So we create the defective trust with a sale to the trust, taking the note back. It's the note that we would gift if we thought the exemption was going to go away. And there's advantages and disadvantages to this trust, which I've laid out, which you might want to consider if you're thinking about this technique. And with that, I'm going to move to what's new with retirement plans for 2020. In our last few minutes, I just want to touch on a couple things. One is the Secure Act came to play at the end of last year. This eliminated the stretch IRAs, so effective for deaths after 2019. So current for 2020, there is no longer a stretch IRA on death except for eligible designated beneficiaries, which are your spouse, disabled beneficiaries, minors, chronically ill beneficiaries, individuals who are 10 years younger than the decedent. Those are the 5 categories that you could still have a stretch IRA. But other than that, typically your children, your adult children, they have to have that paid out in 10 years. It can be at the 10th year, but if you don't pay it out in 10 years, you have a 50% penalty. So if you have any plans that are set in place where you've had these IRAs within a trust, you might want to review those trusts. It may be generating higher income tax and freezing those assets in that trust in a manner that you didn't anticipate. If you have significant retirement plans, maybe you want to visit with one of your tax advisors, because you might want to consider life insurance or charitable remainder trust with life insurance to try to do some planning to alleviate that quick payout of a retirement account, because that retirement account is going to be taxed to your children, both for estate tax purposes and income tax purposes. Also, we're seeing some people who are doing Roth conversions over extended time now because of this 10-year payout. You can do Roth conversion planning as well, and we'd be glad to visit with you about that. The CARES Act is an act that came out after the coronavirus. One important piece of that CARES Act is that provides that if a person is defined as having a hardship under the coronavirus, so your taxpayer, your spouse was diagnosed with COVID, or the taxpayer had experienced financial consequences. There's a whole checklist to go through. But if you meet these statutory definitions, you can pull out $100,000 out of your retirement account early without a 10% penalty on the early distribution. This distribution has to happen in 2020, and the income can be recognized over a 3-year period. So this is a benefit if you need this $100,000. There are some advisors out there who are looking at taking this $100,000 and then doing a Roth conversion with that. That's not the intent of the plan, and the IRS has noted that. So I caution you, if anybody is advising you to take the $100,000 and roll it into a Roth IRA, it's for those people who need that extra payment because of COVID. So final considerations for today. Things to think about in your plan. Estate tax apportionment is one of them. So if there is estate tax that would be owed on your death, make sure you're looking at how your documents address that. We see this many times not addressed, and the state law typically allocates it by value received at death. But if I'd made lifetime gifts, does it make sense on who's paying the estate tax and who's responsible for that after death? Make sure you look at that piece of it. What is fair for each family member? You know, look at the numbers. All I can say is you can have great planning documents, but until you run the numbers, sometimes you don't see or can really visualize how it plays out for your family members. And liquidity for estate tax and debts. Is there enough cash to keep farming if you would die unexpectedly? Does life insurance need to be added to fill that gap? Or is there other planning that we can do so that your family members can continue to farm if something would happen unexpectedly? And also, how do we treat the farm children versus the non-farm children? What's fair versus equal? It's difficult to define, and it varies greatly among families. But think about that ahead of time. Sometimes that illustration helps you visualize how that plays out between the farming children and the non-farming children. If you have specific bequests of farm assets to the farming child, what do you do for the non-farming children? Are the farming children, are they allowed to sell out of those farm assets? Can the farming child afford to buy them out? Do you need, again, is there life insurance we need to look at, or certain buy-sell provisions, maybe in an operating agreement like under a partnership? Think about that ahead of time. And the lessons learned, I've learned over the years, permanent only means permanent until the tax law is revised. So we can plan for the law we know today. Today we know we have 11.5. We know it's going to drop to 2020. In 2026 to about 6 million. Be prepared and make sure your planning documents allow for that change. Make sure they're flexible. Be aware of the potential changes. We know the Democrats are talking about additional changes possibly. Will that 2026 happen earlier than expected? We don't know. Again, the best plan is one that provides for flexibility. With that, I thank you for joining us today. I would be glad to stay online if anybody has any questions, or feel free to reach out in the future if you have questions for me. Thank you.